Welcome back. So the next session is going to be on the issues in faceless assessments. I'm sure all of you will be grappling with the issues, lot of challenges with faceless assessment. So we have an expert who will be addressing all of us on the issues and how to resolve those issues, or to at least to tackle those issues of faceless assessment. So I request Treasurer Manjunath Hallu to escort the speaker of the session, Deepak Chopra, CA Deepak Chopra. Please give a floral bouquet, Manju, to as a welcome, Brett. Thank you, Manjunath. So let me introduce the speaker. Deepak Chopra is a fellow member of the Institute of Chartered Accountants and has graduated in Commerce from Bangalore University. He is qualified as a chartered accountant since the year 2011. He has a strong passion for direct taxes and has been regularly taking classes for students, company secretaries of students of CA, company secretary and the chartered accountants. He is regular faculty member at Bengaluru branch for direct taxes for the CA students. He has also been a resource person on direct taxes matters at various forums, at Bangalore, Tumkur, Davangere, Hyderabad, Mangalore, Tirupur. He's all over, Hubli, and the list goes on. He has been a resource person for session hosted by committee for members in practice. He has also been a faculty for income tax department officers at the Direct Tax Regional Training Institute, Bangalore. He is also a member of the Direct Tax Committee at KCA, Karnataka State Chartered Accountants Association, and currently he is a partner at Deepak Neeraj and Associates, where he heads the Direct Taxes Division. Welcome to you, Deepak. Thank you so much for taking your time and coming to share your knowledge with us. Thank you so much. Please, floor is yours.
Namaskar. A warm good afternoon to one and all. I have been asked to share my thoughts over the next 80 odd minutes over various issues that we face in a tax assessment. At the outset, I am extremely grateful to my mentor, CA Shri Naveen Khariwal sir, and of course the organizers for having given me this opportunity. Assessment order or assessment proceeding is a bedrock, it's a pillar based on which all subsequent proceedings under the Income Tax Act are carried on. Be it appellate proceedings, rectification proceedings, revisions, penalty proceedings, and at times even prosecution proceedings. All of these are greatly impacted and influenced by what transpires in an assessment proceeding. In fact, a lot of times, an assessment order for one assessment year has lasting implications over assessments of subsequent years as well. So it is of paramount importance that the assessment proceedings of our clients are handled with utmost caution in the best interest of our clients. Now, talking of various issues that arise in an income tax assessment, to my mind, each of the issue that we face in the course of an assessment proceeding has its origin in any of these four that you see on your screen. The first category of issues that we most commonly face mostly originate from the assessing officer. The notices served by the assessing officer, huge data required, very little time given. There are notices asking us, expecting us to submit technical replies, requires a lot of research, a lot of analysis, a lot of study to be done. Then there are notices which require us to give fact-based responses. There again, there's a huge amount of data analysis, data collation, reconciliation, a lot of hard work to be done. Now, in the next few set of slides, we may not be able to address the fact-based queries that we normally face in our assessments, but then yes, we will try to address some of the technical and legal issues that we face in our tax assessment. The next segment is devoted towards issues created by the assessee himself, self-goals. Now, there are a lot of do's and don'ts that we should be cautious about to ensure that we don't end up creating issues for ourselves or rather for our assessees. And then there is a third segment, that is issues arising out of the faceless environment, out of the faceless assessment regime that we are presently under. And then fourthly, we'll conclude our session for the day with my favorite segment of issues, which are issues that an assessee or a representative should create, not for himself, but for the but for the assessing officer. Now, there are a bunch of areas where we should be troubling the officer as well, and he should be made to look out for certain solutions and certain resolutions. Now, with this broad outline, let's begin with our first set of issues, which are technical issues that originate from an assessing officer in most assessment proceedings. Short notice, inadequate time. I'm sure all of you over here would agree with me, particularly with regards to the ongoing assessments for assessment year 21-22, which are due to conclude before 31st of December 2022. We've all faced this issue, no? Notices running into pages requiring voluminous, mammoth amount of data, but the time allotted is very little. Right? This is something that we faced often. More so in the ongoing assessments, because the assessments were picked up for scrutiny somewhere in the 3rd or 4th week of June. The department slept over it in the months of July, August, September, October, and in fact, good portion of even November. Towards the fag end of November or early December, we've started receiving notices running into 3 pages, 5 pages, requiring huge reconciliations, requiring a lot of research, a lot of legal response, but then allowing very little time. Is this fair? Is this legal? Is this at all permissible? And then the best part is all notices end with a standard line. If the required data is not provided before so and so date, the assessment would be concluded on the basis of information available and to the best judgment of the assessing officer. Now, what is the legal position with regards to such short notices? Is this allowed? Is this legally permissible under the scheme of law? There is no section under the Income Tax Act which would govern this issue, but then over the years, law has pretty evolved, and it is now pretty much settled that assessment proceeding is a quasi-judicial proceeding. And like in the case of any other judicial proceeding, principles of natural justice have to be adhered to even by the assessing officer. And the fundamental principle of any natural justice is to ensure a fair and unbiased hearing, a fair and unbiased opportunity for the assessee to represent himself. When any of the cases where this fundamental principle of natural justice is not followed, if sufficient time as would reasonably be expected to respond to a notice is not given, then it's a clear case of violation of principle of natural justice. And repeatedly, more so in the recent past, in the particular context of faceless regime, courts have held order not following the principles of natural justice is bad in law and is liable to be quashed. But then officers are also, their hands are also tied is one argument that one may make on behalf of the assessing officer. The assessments are getting time barred on 31st of December. He has to conclude his assessment, but then it is his administrative duty to manage his assessments. The assessment was picked up in the month of June. Nobody stopped him from issuing notices in the month of July, August, or September. It is to his own peril that he is chosen to remain silent until the fag end of the limitation period. And now the assessee cannot be burdened by such short notices. So what is it that we should do? Wherever possible, to the extent the data is available, collate it, respond to the notice with the available data. But at the same time, in your notice, also incorporate maybe some of these points, highlighting the fact that the assessment is getting rushed. And in this rush, the assessee should not be penalized. The assessee should not suffer a disallowance or an addition which he would not otherwise had he been given sufficient opportunity. Right? This is a highlight, or this is an emphasis that you have to lay out in your responses to the assessing officer, and if required, maybe even seek for an adjournment. Now, this brings us to the next issue. issue of seeking adjournment. Is it my right to seek an adjournment? Every time I seek an adjournment, is the assessing officer bound to give you that adjournment? Is he bound to give you additional time? Unfortunately, the law as read by Madras High Court in the case of Bhavarlal C. Bafna, 257 ITR, the High Court there has concluded that adjournment is not a right of the litigant, or it is not a right of the assessee. It is to the discretion of the officer or the judge who is granting the adjournment. But then, like in the case of all discretionary powers, this discretion also has to be exercised judiciously. So it has to go and it depends on the facts and circumstances of the case. If the facts and circumstances of the case demand that the assessee or the litigant be rewarded additional time, the assessing officer is bound to give sufficient and reasonable time to the assessee to file his responses. But then at the same time, we also have to be cautious. We cannot be asking adjournments in a routine and general manner. For every notice served, please don't ask adjournments. As I said, adjournment is not your right. You cannot ask for it, you have to request for it. Right? And more importantly, all adjournment requests should be filed in writing, and it should be filed with detailed reasons and explanation. A single liner, kindly adjourn the case by 10 days or 15 days, is not the right way of seeking an adjournment. Your adjournment should be a minimum of half a page request elaborating the reasons why you seek an adjournment. You have to spell out the specific issues or reasons which have forced you or which have necessitated you seeking an adjournment. It could be reasons like the data that is being sought is voluminous, it is something not readily available, it requires effort of multiple accountants over multiple days, or maybe your chief accountant is unwell, possibly attach some of his medical records. Be as it may, the core of the matter here is the adjournment request should be a detailed one, and wherever possible it should go along with additional documents, as like in the case of medical records of your accountant, should be supplied wherever possible and wherever available. And most importantly, adjournment has to be sought before the date of hearing. There's this very harsh case of AIM Fincon Private Limited decided by Calcutta High Court. The facts of the case are pretty interesting. Now, it was a case of 263 proceedings before a CIT. The CIT had posted the case for hearing on the 10th. Unfortunately, on the 9th, a senior CA member of the firm representing the assessee expired, and nobody could be present for the hearing on the 10th. A request for adjournment was filed on the 12th, which was disregarded, and on the 13th, CIT went ahead and passed its order. The assessee carried this in a writ before Calcutta High Court, which was dismissed on two grounds. Reasoning number one given by Calcutta High Court, slightly insensitive. 9th, the senior member of a CA firm has expired, the junior could have applied for an adjournment. That's noted in the High Court ruling. If not, at least the assessee could have applied for an adjournment. Somebody from the company could have applied for an adjournment. Secondly, with regards to the adjournment request filed on the 12th, the court held a request for adjournment after the date of hearing has no meaning. It has no validity. At best, the assessee should have requested for reposting the case for hearing, which was not done in the case, and therefore the CIT was right in passing the order on 13th. And mind you, the CIT's order takes cognizance of the request filed on the 12th, takes cognizance of the fact that a CA who was representing the assessee had passed away. But then these are the rigors of law, and these are the legal mess that one can land up if things are not handled carefully. Moral of the story is, any adjournment should not be casually handled. It has to be cautiously handled, and you have to be prepared for a scenario where your adjournment request could possibly get rejected also. So you ask for 15 days, the officer may reject it and say, no, file it before tomorrow. So you should have a plan B in place as well wherever you are opting for this adjournment route. Next issue is with regards to proof of deduction. primary evidence versus secondary evidence. Let us discuss this with the help of a simple example. Let's say I have an SSE who has made additions to his fixed asset block. He's bought plant and machinery, say worth 30 lakh, on which he's claimed depreciation. In the course of assessment, there is a casual inquiry, produce invoice copy for proof of having made additions to your fixed asset schedule. Now, unfortunately, the client responds, bill copy is not available, it is missing from the records, or the records are missing. Now, what do we do? What recourse, what options have we got in such a scenario? In such a scenario, possibly you would try to prove the fact of addition to fixed asset through other means, because it's a Triton law. No fact is proven unless and until it is accompanied by an evidence. So since your primary evidence is missing, you will probably try to bring in some secondary evidences, like maybe you would supply the ledger extract of the vendor who supplied you the machinery, provide a copy of the bank statement wherein you can highlight the proof of having made a payment to the vendor, produce GSTR 2A extract wherein the vendor has uploaded his sale invoice and which is reflecting on your purchase register in the GST portal. Maybe produce photographs of the machine. Hey, see, this is the machine that I had bought 2 years ago and it is still in use, it is still lying with me. This is the machine on which I am claiming depreciation. Explain to the officer your production process. See, these are the raw materials that I buy and this is the product that I sell. It is impossible to convert this raw material into this product without this machinery on which I have claimed depreciation. So you do all of the hard work, but still get a show cause notice. Assessee has failed to produce invoice copy. Therefore, I propose to disallow depreciation. So where do we legally stand in such a scenario? Is there a legal backing to these secondary evidences? Yes, there is. There have been n number of judicial pronouncements, most prominently by Madras High Court in the case of Southern Seafoods Limited, wherein the court has exhaustively discussed this piece of law of evidence and has concluded that in a case where the primary evidence is missing for a reasonable or a sufficient cause and the assessee brings in secondary or circumstantial evidences, the assessing officer is bound to respect those evidences. He has to take into account, and after having taken into account those secondary evidences, he has to pass his assessment order. Next issue that I have chosen for discussion here is AO cannot make a good proof a bad proof. Now, this is something that we often face, mostly in cases involving, let's say, allegations of bogus purchase. So, assessing officer has in his possession some report from GST department that so-and-so assessee has made so-and-so bogus purchases from so-and-so alleged supplier of bogus invoices. Now, he would begin the assessment with a hell-bent mind that this item has to be disallowed. The assessment order has to finally conclude with a addition on account of bogus purchases. There has to be a section 68, 69 addition in the case. In the course of assessment, you would have done your best to defend your assessee. You would have supplied with a plethora of records. You would have submitted invoice copies, e-way bills, GSTR 2A, 2B, bank statement evidencing payment, maybe LR and courier receipts evidencing movement of goods, inventory record showing that there was actual movement of goods, there was actual purchase, there was actual sale. Notwithstanding all of this, again a show cause notice would ultimately be served on you. Reading, assessee was given opportunity to justify or evidence his purchases from so-and-so dealer, and the assessee has failed to do so, and therefore I propose to make a disallowance or make an addition on account of bogus purchases. You've given all that you had, and still when the response comes that the assessee has failed to prove, is when you're hurt. This is where this legal principle comes into play, wherein the courts have held merely by rejecting the explanation and without finding any fault in the submission of the assessee, he will not dispute any of your evidences, all the documents, all the submissions that you made, he will not find a single fault. But then he will still say that you have not proven your case, which is where courts come to the rescue and say, by mere rejection of a valid explanation and without finding a single fault without finding any default in the submissions of the assessee, the assessing officer cannot make a good evidence a bad evidence. The onus of proving what was apparent is not real is on the party who claims it to be so and not on the counterparty. On the face of the documents that I have submitted, all the records and submissions that I make, apparently mine is a case of a genuine purchase. If the apparent is not true is what the officer claims, then it is his duty to disprove me rather than me to prove myself again. Right? This is the fundamental principle of law. This should form part of your response to the show cause notice. So after I respond, he'll allow me. No, he's still not going to allow you. Most likely your final assessment will be same as what was proposed in the show cause notice, but then this serves as a base for your next level, that is your appellate proceeding, right? So this was with regards to technical legal issues that we face before the assessing officer. We now move on to our next subsegment, which is issues with regards to various disallowances and additions that are normally posed to us by the assessing authority. Addition on account of low gross profit rate. Pretty common point of dispute between us and the department. Na? Last year GP 18%, current year GP 12%, show cause notice, I will make an addition of 6%. But then again, as you would see on your screen, there are a plethora of cases in the favor of assessee wherein the courts have concluded that if the assessing officer does not find any fault in the books of accounts of the assessee, if the books of accounts of the assessee are not rejected and inventory records, very important, if inventory records are maintained by the assessee, then the assessing officer has no right to tamper with the GP rate of the assessee. I'll repeat, if the books of accounts are not rejected, if there's no fault that he finds in the books of accounts of the assessee, and very importantly, if the inventory records are maintained and you've shown it to the assessing officer and he even there finds no fault, he finds no mistake over there as well, then he has no right to tamper with the gross profit rate of the assessee. Now that's a best case scenario where your client has maintained inventory records, but most of our cases with regards to GP addition are cases where proper or detailed inventory records are not maintained by the assessee, which is where you'll have to look out and see what facts, what further elaborations you can make to support or defend your assessee. A bunch of sample or possible explanations that one can provide to support a reduction in the gross profit rate is on your screen. One possible explanation could be increase in purchase costs with no corresponding increase in the sale price. So if this is something that you can demonstrate to the assessing officer, hey, see, this is the same product that I've been selling in the present year and in the earlier years. Earlier years I've been selling it at 100 per unit. Current year also I've been selling it at 100 per unit, but then look at my purchase cost. My purchase cost has risen from 88 to 94. So there's a 6% hike in my purchase cost, which is why my GP has fallen down from 18% to 12%. This has to be demonstrated with evidence. So you have to pull out sale invoice copies of the current year and the preceding year showing stagnant sale price. You also have to pull out purchase invoices of the current year and the previous year showing a increase in your purchase cost. General market or industry position with report of any trade body can also be presented. For example, World Trade Council came up with a report that the gross margins of jewelers in the last quarter have increased. You'll have to pull out a report where it says it is decreased. That can help you in your assessment. Sale of a particular lot of goods at a huge loss. My purchase price and sale price have been more or less consistent. My margins have been consistent as was in the previous year. But then I had one purchase transaction. There was one lot of goods which I purchased at 10 lakh, which turned out to be defective, which got damaged. And I ended up selling it at 1 lakh, resulting in a gross loss of 9 lakh, which has pulled down my gross profit for the current year. So if something of that sort is available in your facts, that has to be pulled out, neatly compiled and properly, effectively explained to the assessing officer. Forex fluctuations, this could be another reason. My purchase price and sale price continue to remain the same. I used to sell this product at $1 per unit in the previous year. In the current year also, I've been selling it at $1 per unit, but then the rupee is appreciated from 85 to 80, and therefore my gross margins have fallen down by 5 rupees per unit. This could be an explanation. Change in the product or brand being traded. So previously I was trading in product A of company X, now I'm trading in product B of company Y. So it is not at all comparable. It is incorrect to apply GP rate of earlier year where the product and the company with which I was dealing is totally different from the product and company which I am dealing with in the present year. So that can also assist you in fighting out your GP addition with the assessing officer. Next issue, closing stock addition on the basis of stock figures submitted to the bank. Now this is a very dangerous position for the assessee to be falling in, and even more dangerous for the CA to be falling in. So the assessee has reported closing stock of 10 crores in the financial statements in the income tax return, but in the stock statement given to the bank, the stock figure reported is 12 crores. And fortunately, unfortunately, income tax department has somehow been able to lay its hands on the stock statement that you have submitted to the bank. Of course, it will proceed with the addition. It will propose an addition of 2 crores on the basis of stock figures that you have submitted to the bank. Now on this issue, there are a plethora of judgments which will go against you. I have for today's session culled out only those judgments which have fortunately ended up in the favor of assessee, which you may consider making use of. So there is this Chandigarh tribunal judgment wherein the tribunal concluded that the figures which are submitted to the bankers are provisional numbers. Those are estimates. Whereas the numbers which get captured in the financial statements are verified and audited, and therefore it is the 10 crore number which has to be adopted and not the 12 crore number which is given to the bank. So that could be one reasoning to give. There have been extreme cases wherein the assessees have went ahead and admitted before the department that I inflated my stock number. The stock statement that I gave to the bank was inflated to secure a higher borrowing limit. And some of these cases, the courts, Gujarat High Court, Madras High Court, have bought the argument and have given relief to the assessee to say, okay, this is admittedly inflated number which cannot be adopted for a tax proceeding. For the purpose of income tax, Article 264 of the Constitution of India, tax has to always be collected on the right quantum of income. Even though the assessee might have submitted a wrong number, inflated number to the bank, the same should not be adopted for the purpose of conclusion of a tax assessment. Interest on taxes allowable as deduction. A huge list of taxes are payable by a assessee today. There is profession tax, there is PF, there is ESI, there is GST, there is TDS, and all these laws have provisions for payment of interest wherever there is a delay in remittance of taxes, the delay in remittance of dues to the government. The question here is, the issue here is, should this interest be disallowed or can it be claimed as a deduction? To further refine this question, is this something which is to be disallowed under section 37 subsection 1? 37 subsection 1 talks of disallowance of expenses which are for an offense or which are prohibited under law. So the moot question here is interest for delayed remittance of taxes penal in nature, or is it something that can be allowed as deduction under section 37(1)? Again, bunch of cases wherein the courts have concluded that all of these interests are not penal in nature. So interest paid for delayed remittance is time compensation of money which an assessee pays to the government for delay in making remittance, and these are not penal in nature and these are not to be disallowed. These are not to be added back in the income computation of the assessee. Next issue is on section 14A. Now, thankfully, with dividend and long-term capital gains now being taxable, the ghost of 14A is out of most of the assessments. Yeah, 14A was like a ghost only, no? Even in the cleanest of tax returns, in the smoothest of assessment proceedings, suddenly in the assessment order, a 14A ghost will prop up. Thankfully, as I said, because the dividend income and capital gain is now taxable, 14A ghost is gone from most of the cases. It only remains now in cases where the assessee has made an investment in a partnership firm or in an LLP and where the assessee is earning exempt income being share of profit in the partnership firm or LLP. There are a plethora of tribunal judgments which go in the favor of the assessee, the moot judgment being that of Bombay Tribunal in the case of Novel Enterprises, wherein very interestingly tribunal said the earning of profits from the partnership firm and the capital account invested in a partnership firm are two delinked activities. These are two delinked areas, not to be connected, not to be cross-connected. So as long as your partnership deed does not link your profit sharing ratio with your capital investment ratio, this judgment comes to your rescue to say a 14A disallowance is not called for with regards to the interest that the assessee pays on the money that he is borrowed and invested into the partnership firm. Right? So I'll repeat, if your profit sharing ratio is let's say 1:1:1 and capital investment ratio is probably there is no ratio or it is a ratio totally delinked with your profit sharing ratio, then a 14A disallowance is not called for is what Bombay Tribunal says. You will find certain partnership deeds wherein the profit sharing ratio is linked to the investment that the partners make in the partnership firm. In those cases, you cannot be seeking shelter under this tribunal order. Those cases probably a 14A disallowance is called for, but in all other cases where there is a delinking of investment activity and profit earning activity, a 14A disallowance is not warranted. Ad hoc disallowances, another area I'm sure all of us have at some point experienced in our tax assessments, more so in our erstwhile assessments where we had a physical interaction with the assessing officer. So assessment started a year ago, notice after notice, submission after submission, the case is not moving forward. The officer is unable to find any issue or any point where he can make an addition and close the case. So at some point even the officer would get tired and say, hey, see, your traveling expenses 10 lakh rupees. I will make an ad hoc disallowance of 10%. Let's close the case. We would also gladly agree to it. Take a client confirmation. Done, sir. You make the addition. I will not appeal. I will pay full taxes. You don't levy any penalty. Deal done. Case closed. This is a happy scenario if the ad hoc disallowance proposed is a reasonable disallowance. But if a unreasonable quantum of disallowance is proposed, let's say instead of 10% he proposes to disallow 90%, I will make a disallowance of 9 lakhs. Then is where you have to get your antennas up and you have to get more active and maybe consider some of the points that I have put out on the slide before you. Now in all these cases where there is a proposal to make a disproportionate ad hoc disallowance, the precautions that one must take is produce as many vouchers or documents as possible to support the expense. Don't look at the materiality. Travel expense may have a 400 rupee cab bill also, but please scan that and upload that as well. So as many documents as possible, as many evidences, as many submissions as possible with regards to your the expenditure which is proposed to be disallowed, please submit it to the assessing officer. Where vouchers are self-made, detailed note has to be given as to why it is self-made. Some coolie charges 500 rupees paid to a laborer. Of course, laborer is not going to give an invoice. So it has to be a self-made voucher, probably having initials or thumb impression of the laborer. So in all those cases where you are making a submission of a self-made voucher, please also attach a note explaining and justifying why it is a self-made voucher and why it cannot be a invoice coming from the counterparty. Where there are no vouchers and the payments have gone through banking channels, bank statements evidencing payout may also be submitted. A note on the general business and industry practice may also be provided. For example, in transport industry, the driver is on the go, on the road all the time. He will neither give you an invoice, he will not give you a voucher, he will also not give you a bank payment proof. So this is how the entire industry operates. This is the norm, this is the practice in the industry, and this is the practical constraint that one faces in an assessee who is into this transport industry. So half a page, 1 page note elaborating why and how the assessee is landed up in a position without any evidence and without any documents to be provided in support of the expenditure should be provided. And this is something that they have to look into. They have to look into the commercial practice and industry-wide prevalent practices for the conclusion of tax assessment. If the books of accounts have been audited, that fact may also be stressed in the submission. I see my balance sheet is audited. Balance sheet reports a cash balance of 10,500 which has been verified. I had a bank withdrawal of 50,000. So 40,000 has necessarily been spent somewhere, no? So that is another point that you can add in your submission in support of your deductions. I will also leave you with a bunch of case laws favoring the assessees. Each are different in its fact pattern. Depending on what fact pattern matches with the facts given in these cases, you may make use of these in your submissions before the officer. I'll move on to the next issue. 3613, disallowance of interest with regards to interest-free loans given to the sister concerns or relatives. This is again, we've seen this quite often in assessments. No? So, assessee has own funds on the liability side, he has interest-bearing funds, and on the asset side, there are business assets, and there are certain loans and advances which are made to sister concerns or relatives and which are interest-free. So the contention that comes from the department usually is that you have diverted these interest-bearing funds to non-business uses, non-business applications. So the interest that you have debited to your business P&L, I will disallow it. I will not allow it as a deduction under 3613. Now this is again a slightly fact-based issue. If from the facts of your client's case, you can identify, you can establish a money trail. See, this interest-bearing bonds have clearly gone into business asset. See, what loans do I have? I have a vehicle loan. It is directly paid to the vendor who's sold me the vehicle. I have a machinery loan, again directly paid to the vendors who have sold me the machinery. If this kind of a correlation, if a direct link, direct nexus can be established, nothing like it. Your case is very smooth and easy to sail, but most cases this is not what happens, right? Most cases the assessee has a common pool. There is a stream of money flowing in by way of capital introduced, by way of interest-free loans, and there is a stream of revenue coming in by way of interest-bearing loans. It all gets mixed in one pool from where you have two outward streams, one going to business assets and the other going to non-business assets. Now in such scenario where neither the officer nor the assessee is in a position to clearly establish one source with the other outflow, Supreme Court in a landmark judgment in the case of Munjal Sale Corporation has held in all such scenarios where there is sufficient own funds available in the hands of the assessee, it necessarily has to be presumed that the non-business application is out of own funds and business application is out of interest-bearing funds. To give you an example, let's say I have 4 crores of capital and I have 4 crores of bank loans. On the asset side, I have 4 crores of business assets and 4 crores of non-business assets. Where I am not able to establish a money flow, a money linkage, Supreme Court says it has to be presumed that the 4 crores of interest-bearing loans have gone into the business and 4 crores of own funds have gone into non-business usage, which necessarily means interest disallowance under 3613 cannot be done. Next issue, expenses incurred for raising funds. Now the funds raised are capital funds. You've issued shares, equity or preference, doesn't make a difference. And to issue those shares, if you've incurred any expenditure, it could be in the form of ROC fee, stamp duty, consultant fee. Now all these expenditures are not revenue in nature. These are capital expenditure on which you're not going to get any depreciation either. So these are sunk costs which have to be disallowed. You cannot be claiming this as expenditure in your return of income. But then if the fund that you have raised is a debt fund, it may be a long-term fund, it may be a 15-year debt, it may be a 25-year debt. But then as long as it is a debt, courts have time and again held that it does not increase your capital base. The expenditure incurred to raise a debt does not provide you any benefit of enduring nature. A debt ultimately has to be repaid. and therefore all expenses incurred in connection with raising a debt capital has to be allowed as a business expenditure, has to be allowed as a revenue expenditure. Now the case becomes interesting where the debt is a convertible debt. Even more interesting where it is a compulsorily convertible debt. Now that's the case which came up before Karnataka High Court in the case of ITC Limited. Now ITC had issued CCDs, compulsorily convertible debentures, and had it incurred some expenditure towards the issue of CCDs, which it sought to claim as deduction as a revenue expenditure. The matter went up to Karnataka High Court, wherein the department objected to say, see, the expenditure is incurred to issue a convertible debt, and this convertible debt is a compulsorily convertible debt. So in effect, what ITC is issued today is capital. It is something which is never going to be repaid. But then High Court went on to hold it in the favor of the SSE on the basis that at the point of raising the funds were in the nature of a debt, and as long as it is in the nature of a debt, the expenditure incurred to raise that debt has to be allowed as deduction. After conversion or expenditure incurred in connection with conversion can be disallowed as a capital expenditure, but up until the point where the money is in the nature of a debt, it has to be allowed as the expenditure, the corresponding expenditure incurred has to be allowed as a revenue expenditure. Provision for expenses is TDS applicable. Is TDS applicable on provision for expenses? Let me give you a small example, a very easy example. At the end of the year, I have made a provision for audit fee. Audit fee account debit to provision for audit fee or audit fee payable account, 50,000 rupees. On this transaction, on this accounting entry, should I be deducting tax at source? That's the question. The answer given to us by Bangalore Tribunal in the order of the cases that you see is yes, no, yes. 2015 tribunal said yes, then 16 it changed its mind, no, and 17 it is again reverted back with the answer yes. And mind you, all these three are Bangalore Tribunal. So in 2016, in the case of IBM India Private Limited, it was argued that TDS provisions are not charging provisions. They don't create an additional charge. As long as there is no income which is accrued in the hands of the recipient, there cannot be a TDS liability. That was the contention made. So in the case of our audit fee example, the audit fee provision is made in 21-22, but the fee is billed and received in financial year 22-23. When do we offer this to tax? Obviously 22-23 and not 21-22. So in the year 21-22, there is no income which is accrued or arisen in the hands of the recipient, and therefore there is no need to deduct any tax at source. TDS is not a charging provision. TDS provisions are only recovery or collection provisions which facilitate in collection of taxes but do not levy additional taxes. Unfortunately, the tribunal did not buy this argument. It said no, TDS provisions are dehorse the charging provisions under section 4 or 5. Tax has to be deducted at source at the point of payment or credit, whichever is earlier. And the credit could be to any account. It could be to a vendor account, party account, it could be to a suspense account, or it could be to a provision account. So that was IBM India in 2015. But in 2016, Bangalore ITAD had a change in mind. Bosch Limited. There they referred to G Technologies case by Supreme Court and said, no, there cannot be a TDS sans accrual of income, and therefore there is no requirement to do tax deduction at source on year-end provisions. But then unfortunately that again got reversed by the same Bangalore ITAT in the case of Toyota Kirloskar Motor Private Limited, wherein they said no, even on year-end provisions, tax has to be deducted at source. Interestingly, Toyota Kirloskar case made reference to Bosch Limited case. It took cognizance of the fact that there is an existing Bangalore ITAT judgment which has gone in the favor of SSE, but then it distinguished it on facts to say it is not applicable. And the distinguishment was made on the ground that in the case of Bosch Limited, provision entries were passed on 31st of March, let's say 2022, and 1st April 2022, the provision entry was reversed. But in the case of Toyota Kirloskar, provisions were made on 31st March 2022 and it was reversed on 31st March 2023. Therefore, Bosch ratio cannot be applied for Toyota was the conclusion of Bangalore Tribunal in the case of Toyota. And there was another interesting observation. The Toyota case was a 2011 case. It was not a 40A1A disallowance case. It was a case of assessee in default under 2011. There, the tribunal observed that Toyota in its own income tax return had admitted a 40A1A disallowance with regards to year-end provisions. So, Toyota itself acknowledged that TDS is applicable on year-end provisions and therefore made a 40A1A disallowance for the purpose of income tax proceeding. But when it came to TDS proceedings, it said that 201 proceedings, 201 assessee in default status is not applicable to me because on provisions TDS is not required to be deducted. So Toyota itself conflicted with its own, stance with regards to what it took in the IT return and what it wanted to take with regards to TDS return. So this was one major fact which drove the tribunal towards concluding in favor of the department. In my view, if you were to ask, wherever the quantum of the provision is reasonably identifiable and you know who the vendor is, you know for whom the provision is being made, then tax has to be deducted at source. Tax has to be deducted at source. The only scenario where you may argue that TDS provisions are not applicable is a scenario where you made provision for expenses, but you don't know who your ultimate vendor is going to be. You don't know to whom it is going to be paid. So I'm into a construction contract. I know there is X amount of expenditure that has to be incurred and it is provisioned in my financials for 21-22, but I am yet to finalize on a vendor. Right? So where a vendor is not identified, there maybe the TDS charge is attracted, but then the TDS machinery provisions fail. After having deducted tax on that expense amount, to whom do I credit it? What do I state in my TDS return? So only in those cases, possibly one might argue that TDS provisions are not applicable, but where the quantum is known and the vendor is known, I think there is very little scope for us to take a argument that TDS is no longer applicable on those cases. But then if this is the stand that you're taking before the officer, that I don't know who my vendor is, the next contention that is going to flow in from the officer is, this is a contingent liability, this is an unascertained liability, this is the expenditure you have not incurred, this is the ad hoc provision you have made, I will disallow not 30%, I will now disallow 100%. So what stand you take in your assessment is something that you have to carefully analyze, deliberate, and then decide. Which brings us also to our next issue with regards to allowability of provision for expenses. Time and again, department comes to us with notices and our contentions that the provisions made in our financial statements, provision for expenses made in our financial statements are unascertained, these are contingent, these are expenses which are not incurred and therefore cannot be allowed as deduction for the tax assessment year that is under consideration. Now this argument of the department misses the very fundamental reading of section 37(1), which reads any expenditure not being expenditure of the nature described in section 30 to 36 and not being in the nature of capital expenditure or personal expenses of the assessee, laid out or expended wholly and exclusively for the purpose of business. So the act does not restrict only to expenses which have been actually expended, which have been spent. The word laid out is very much there in the act itself. You don't have to be relying on any High Court, Supreme Court judgment to be defending yourself on this case. What is laid out? Laid out means provision. Those expenses which have not been expended yet but have been provisioned is what is very specifically allowed under section 37(1), and this is something which is settled way back in our 37 ITR, Supreme Court Calcutta Company Limited, wherein the court has also concluded that if a liability has been definitely incurred in the accounting year, that is, it is an unconditional contractual liability, then it cannot be regarded as a contingent merely because it is to be discharged at a future date and the cost of discharging is not definite but has to be estimated. So even if there is some element of estimation involved, you don't know accurate numbers that you're going to spend, but you have reasonably and scientifically estimated your provision for expenses. The Supreme Court is also with you. The core provisions of the Act are also with the SSE to say this is an expenditure which has to be allowed as deduction. Reference may also be made to Rotok Controls and Mitsubishi Motors. Both are Supreme Court judgments. I have one small issue on 48.3. 48.3, as we saw in the morning, refers to disallowance of expenses made in cash in excess of 10,000. Now, would this disallowance attract in cases where the SSE has made a direct deposit of cash into the bank account of the vendor? I have not paid the vendor in cash. I have not paid him through banking channels, but I have deposited cash into his bank account. Is disallowance attracted in such a case? There are a couple of beneficial judgments which go in the favor of the SSE to say, no, in these cases, a disallowance is not called for. And with regards to quantum of disallowance, we've had this discussion in the morning as well. So if, let's say, there is an expenditure of 12,000 paid in cash, what should be the quantum of disallowance? Should it be 12,000 or 2,000? Karnataka High Court in a division bench, Dharwad bench, has held that it is 2,000 which is to be disallowed and not 10,000. But then not a very detailed judgment, if I may put it politely, half a page or 3/4 of a page judgment. There is no rationale as to why 2,000 and why not 12,000. So this is, to my mind, definitely subject to future litigation and not a good case law to be attacking with to the department, but it can certainly be used in defense. So if your assessee is stuck in a case and in the case of proceedings, it has been found out that there are cash expenses in excess of 10,000, then you may use it as a defense, but certainly not as a planning device at the time of finalizing the return itself. Section 68, unsecured loans. This was also very briefly touched upon in the morning session. So, an unsecured loan cannot be taxed under Section 68, as that is unexplained cash credit, if the following are established. That is, identity of the lenders, genuineness of the transaction, and creditworthiness of the lenders. If these three components you are in a position to establish before the assessing authority, then there cannot be a Section 68 disallowance. And of course, Finance Act 22 brings in another requirement of proving the source in the hands of the source, which is of course not applicable for our present assessment proceedings. Ongoing assessment proceedings, if these three components are established, then you have sailed through in your case. Now, how do you establish this is the question. How do you establish an identity of a lender? Depends on the status of the lender. If the lender is a corporate entity, let's say it's a LLP or a company, then the best way to establish the identity of the lender would be to produce the certificate of incorporation. In case of an individual, the identity is to be proved by PAN card, Aadhaar card, voter ID card, DL, right? That is what proves my identity. Who am I? I am Deepak. What's the proof? It's my Aadhaar card, my PAN card. That is all that I can present as proof of my identity. Genuineness of the transaction. The best record that you can provide in support of genuineness of the transaction is the bank statement. Provide your bank statement evidencing transaction with the creditor, and if possible also provide bank statement of the creditor showing a inflow, corresponding inflow or outflow in his account as well, right? Creditworthiness of the lender. This is where the majority of the dispute, well, majority of the problem normally arises. How do you prove the creditworthiness of the lender? A best case scenario would be a case where you've taken a loan of 5 lakh from a lender and the lender has filed a return of income declaring a taxable income of 10 lakh. So simple confirmation from the lender together with this ITRV copy, say he's a person earning 10 lakh of annual income, he's given me partly loan of 5 lakh, which is definitely within his credit limits. That's a best case scenario. Problem arises where you've taken a loan of 50 lakh and the lender has filed a return of 5 lakh. So there is where you'll have to pull out some more documents You'll have to give little more justification to justify or establish the credit worthiness of the lender. The common set of documents which come to your rescue in these scenarios are maybe provide the financial statements of the lender, wherein the liability side would explain or justify the asset side, which will have you also as a debt receivable, or maybe provide a cash flow statement which will give sources of funds and application of fund, wherein the loan given to you is justified as having in turn been borrowed from ABC or out of past savings. Again, a slightly fact-centric matter. You will have to take a call on how to justify and how to defend this on a case-to-case basis. Treatment of cessation of liabilities. Section 41. There is a long outstanding creditor in the books of my client. No repayment is happening, no interest payout is happening. Opening balance is equal to closing balance for years together. The department obviously comes with a contention that this is a liability which has been remitted or which ceases to exist, and this is something which is taxable under section 41. But then this contention does not do justice to the interpretation or the provisions of section 41.1. Now 41.1, when is it applicable? It is applicable only when there is a remission or cessation of liability. Now if you can establish with documentary evidence that the amount remains outstanding in the books of the borrower. So in the borrower's balance sheet that liability continues. It has not been written back in the profit and loss account of the borrower, and it continues to be shown as receivable in the books of the lender also. Then these three set of documents would conclusively establish that the liability has not been remissioned or it is not ceased, right? And there are a whole lot of court judgments which would favor you in this. The next contention that comes up from the department is, see, this liability is more than 3 years old. Even under the law of limitation, even under the Limitation Act, this cannot be recovered any longer. This is not required to be paid back to the lender, and therefore now at least in the third year, where in the year in which you have crossed the limitation period of 3 years, it has to be taxed as income under 41.1. No, the answer again there is no, because the law of limitation after a period of 3 years does not extinguish the debt. It only creates a bar on the lender from enforcing the debt. A bar on enforcing the debt is different from extinguishment of the debt. As long as the borrower acknowledges the debt, acknowledges his liability to repay, and he has an intention to repay, there cannot be an addition under 41.1, even with regards to loans and liabilities which are long outstanding, maybe for years, more than 3 years as well. Addition based on AR information. This is another irritant that we often face in our assessments. 26A is reporting FD interest income of 50,000. Bank of Baroda has reported this information, but the client claims and swears by his entire family, I don't have an account in Bank of Baroda. Officer will send you a 142.1. This is the income reported in 26A. This is what is appearing in TIS. Please offer an explanation why it has not been offered to tax. You would respond by a statement that I don't have any bank account. It is a misreporting by the bank which has been done in the form 26A. Notwithstanding your response, you will get a show cause notice. AIS, TIS information reveals that the assessee has earned the interest of 50,000 from Bank of Baroda, which is not offered it to tax in his return of income. I propose to add it. What do you do in this case? These cases come to your rescue there. The gist of these cases is that the officer cannot be forcing an assessee to prove the negative. If I am making a submission before the department that I have an account in Bank of Baroda, I can prove it. I can give my account number, I can give my checkbook, I can give my passbook, I can give a bank account statement. But I cannot be asked to prove that I don't have an account in Bank of Baroda. Negative can never be proved. The information available in departmental records can at best be a good pointer for them to initiate an inquiry. But that information alone cannot result in an addition in the hands of the assessee, particularly where the assessee denies having earned that income and provides a reasonable explanation, justification to the pointers raised by the department. So these cases, including our Bangalore ITAT cases, can be relied and referred to in all such situations. I think I'll jump ahead to my next segment, which includes issues caused by the assessee himself, and then if time permits we'll look at some more issues, or anyways this material is always going to be shared with you. We have a couple of more issues pertaining to the issues which are originating from the assessing officer. We'll park that aside for a minute and we'll maybe towards the end of a session revisit them, time permitting. Issues in assessment category B, we are referring to issues where the assessee is himself responsible for the mess that he's landed himself into. It's a basically self-goal kind of a scenario which should be avoided with certain cautions and precautions that one must take in course of assessment. So the common precautions that one must take while handling any assessment proceeding is: number one, all evidences in support of claim for deduction should be filed at the assessment stage itself. In the erstwhile regime where we had physical interactions with the assessing officer, we would go with a set of submissions and documents, and the look of the officer would tell us whether he is happy with the submissions or not. But unfortunately in this faceless regime, that facility is not available to us. So you never know whether the officer is happy with one document or he needs more documents to substantiate your claim. So it is always advisable to give all possible evidences that you have. Don't wait for him to ask. He will ask only at the time of show cause notice, or possibly he will ask you in the assessment order, and you will have an option to respond only to the appellate authority. So all possible evidences that you can collate, please compile it and submit it at the time of assessment itself. Now, another reason why you should be submitting all your evidences at the time of assessment itself is, in the appellate stage, to provide any additional evidence, that is an evidence which was not submitted in the course of assessment but it is being submitted for the first time before an appellate authority, there's an additional hurdle of Rule 46A that you have to cross for your additional evidence to be admitted. So to avoid that additional set of hurdles that you may have to face in the appellate proceeding, at the assessment stage itself, make endeavors to produce and submit all available evidences that you have with regards to the claims being made by the assessee. All notices to be responded. Don't leave any notice in your e-proceeding tab unresponded. It sometimes so happens that the assessee sends you the same letter twice. You also please file your same response twice. Don't stop with a response button only to the first notice or the second notice and say, okay, it's the same, I don't have to respond to the second notice. Why I'm saying this is because we've seen this often in cases after completion of assessment where such kind of notices are not responded to. I believe it's an automatic system generated activity wherein you are then served with penalty notice under 271(1)(b), 10,000 rupees. And then you end up with an explanation to say, no, this notice is a repeat of the earlier notice and the contents of the notice are already responded to. So if you want to avoid getting into that extra proceeding to be handled on behalf of the client, for which obviously there's going to be no payment, the easier way out is to respond to the notice with the same set of submissions. So if he's sending you notice twice, you also give him submissions, same set of submissions twice. Adjournments should not be sought routinely, and if sought, adjournment requests should be backed with reasons. So this is something which we've already discussed. The adjournment request should be in writing, it should be before the date of the hearing, and it should be backed with valid reasons. Right? And adjournment should not be sought routinely. It creates a very negative impression of the assessee in the minds of the assessing officer. Put yourself in the shoes of the assessing officer. Why is this guy for every notice asking adjournment? Is he trying to hide something? Is he evading some taxes? Is there something in the case that I am missing? Is he trying to unnecessarily drag and buy time from me? So he may get into a more deeper digging exercise, which certainly can be avoided with prompt responses, and adjournments should be sought only in genuine cases where there is an actual need or requirement to seek adjournments. Lastly, and very importantly, verify the submissions and particularly the annexures being uploaded. See, the response is probably drafted by the senior staff in the department, verified and vetted by the senior manager or partner of the firm. But when it comes to the uploading activity, it is delegated to the junior most staff. And we've seen this quite often. In the case of SSC A, annexures of SSC B are uploaded. Worst still, we've seen a live case where annexure has alternate workings, actual workings and workings to be submitted to the assessing officer. So it may be a deep mess that you could be landing into if this is not being properly addressed in the office. So there has to be a check mechanism. As there's a check mechanism for the responses that are getting finalized, there has to be a check mechanism for what is finally getting uploaded. Before that final upload button click, somebody from the senior team should verify as to what is finally getting into the e-portal. Issues under the faceless regime. So there are certain constraints and challenges that are brought in on us under the faceless regime. Under the faceless regime, there is a substantial emphasis on written submissions. So the only way you interact with the department is through submissions in writing. There is no oral interaction. There is no physical or personal interaction between us and the department, which lays a lot of emphasis on what you write and how you write. So your drafting skills are certainly tested in case of an assessment proceeding under the faceless regime. But then, unfortunately, it does not stop with just your drafting skills. The challenge is there on the other side of the system as well. No? What are the skills of the assessing officer? No matter how beautifully you have drafted and elaborated your submissions, the assessing officer should also be competent and skilled enough to understand what you are trying to convey, which is an issue which we face in a lot of cases. Arbitrary allotment of cases. Now this is again a demerit or a drawback of the faceless regime. Under the faceless regime, the cases are allotted in an ad hoc or random manner by National Faceless Assessment Center to assessment units. Unlike the earlier regime where we had specialized circles, we had one company circle dealing with company cases, we had an exemption circle, we had a salary ward for salary cases, we had a range for assessing incomes of professionals. Now that led to some kind of a specialization. So an officer in a company circle would have seen tens of company assessments. At least the fundamentals of corporate taxation would be well known to him. So that benefit of specialization which we used to see in the erstwhile regime is now missing in the faceless regime, but unfortunately there's nothing much that we can be doing about it. Electronic communications is another big challenge that we face in the faceless regime. All notices are today being served on us only through emails, and sometimes we get SMS alerts as well. There is no option to opt for a physical communication. That's not at all an option given to us. Now this becomes a major issue for SSCs who are not tech savvy, or even if they are tech savvy, who are not very frequent in looking at their mails. So a lot of times the notices go unchecked. It is delivered to the mailbox of the SSC, but then the SSC fails to forward it, and it could lead to certain unintended consequences. Now the only safeguard that one could have with regards to this is, so maybe in the portal, in the return, give the ID of that member of the family who's little tech savvy and who's quite frequent in looking at his emails. But then again, we have a constraint of maximum 5 IDs being linked to one mail ID. There, what we normally recommend to our clients in our offices, let's say the 5 mail IDs of the tech savvy son are already exhausted, it is already linked to 5 PANs, and I'm forced to give the email ID of the father who's a senior citizen, hardly looks into emails. In all those cases, what we normally recommend is set up an auto forwarding feature. So all emails that the father gets from the income tax department automatically gets forwarded to the son, who is pretty frequent in looking into his mails, and he would bring those notices to us for necessary action. So that's one precaution, or that's one safeguard that we can possibly try to implement in our offices or with our SSCs. Lack of personal hearing, that's the biggest demerit, that's the biggest challenge of the faceless regime. Presently, personal hearings are being given only at the stage of show cause notice. Before show cause notice, we are not getting any personal hearing, and by the time we reach the stage of show cause notice, We are towards the fag end of the assessment proceeding. The assessing officer is in no mood to listen to any of your arguments, any of your submission. The personal hearing being given is only for a namesake hearing. He will very patiently hear to you without reacting, without asking you any questions. At the end of the video session, he'll say, "You're heard." He will disconnect, and the show cause notice will translate into an assessment order without any variation, including the spelling mistakes. Language of communication in a personal hearing is also a issue for a lot of SSCs, lot of tax practitioners, and in fact for some of the CAs as well. So in the erstwhile regime, you had an option to meet the officer and maybe speak to him in the local language, in the language of the state. But then for faceless regime, the department has adopted only Hindi and English as the medium of communication, which may be a hindrance to some of the SSCs trying to represent themselves, or even for some of the tax practitioners or CAs from official areas in making effective representation before the department. In fact, one of my friends was narrating to me an incident that happened to him a week ago, wherein the officer insisted the CA to speak only in Hindi. Probably he was from the North Hindi speaking states. My friend was pretty conversant with Hindi and he went ahead trying to explain his case in Hindi. But then when the officer started, आपने आपके खाते में 51 करोड़ 55 लाख 290 रुपए का इसका व्याकरण दीजिए. This is something I'm sure which should have gone over the minds of some of my Hindi speaking friends there as well. So that's a practical challenge. Unfortunately, we don't have any ready answers, ready solutions to. Now, this is my favorite category. This is my favorite segment where I wanted to spend some more time. Issues to be raised by the SSC, not for himself, but for the assessing officer. So know your rights. Put the officer also into some kind of a trouble. Let him also do some effort and research as we've been putting under the faceless regime. Number one, first and foremost, check the validity of 143.2. Particularly for assessment years 18, 19 and 19, 20, we've seen a lot of cases wherein the 143.2 notices were unsigned, were undated, were delivered in the email. It was issued before 30th September, the time limit which was then applicable. Now, of course, the time limit is 30th June. It was issued before the due date, but it was delivered to the mailbox of the SSC after the due date. Now, the requirement under 143.2 is service before the due date, not issuance before the due date. So be a little aware and conscious of this fact. See, check whether the notice has been served within the due date and check whether it has been served on the proper email ID. Now, as per Rule 127, the notice necessarily has to be served on the email ID that the SSC has quoted in the income tax return for that year. In your profile section, you may have email ID of your father. In the return of earlier years, you may have quoted the email ID of your tax consultant. But in the income tax return for the year for which 143.2 notice has been served, what email ID has been quoted is that email ID on which 143.2 has to be served. Service on any other email ID would make it a bad service. And these are issues that you have to raise in the course of assessment proceeding. If the assessment proceedings are concluded and an order has been passed, all of these get ratified by 292BB. 292BB creates a bar on the SSC from raising any of these technical issues with regards to non-service, improper service or delayed service of a notice post completion of assessment. Pre-assessment is when you have to raise any of the issues with regards to validity of 143.2. Make fresh claims wherever not included in the return. Now, sometimes assessments turn them into a blessing for the SSC. We've experienced this a lot of time. In the return of income, the SSC was eligible for some deduction exemption which he failed to claim. Take a simple example. ATC 1,50,000 he was eligible to claim, but for some reason in the return of income it was not claimed. Okay, ATC is something that nobody would miss. Let's take example of additional depreciation. So SSC is into manufacturing business. He's bought plant and machinery. The plant and machinery is not a second-hand plant and machinery. It's a new plant and machinery. But out of ignorance or for whatsoever reason, additional depreciation was not claimed in the original return of income. Can I now claim it before the assessing officer in the course of assessment proceeding? Unfortunate answer given to us by Supreme Court in the landmark judgment of Goethe India is no. In Goethe India, Supreme Court tells us that any additional claim that the SSC wishes to make with regards to his income computation has to go through a return of income only. You cannot be making a claim outside the return of income. And because now by the time when the cases are picked up for scrutiny, the time limit to file a revised return is already gone. it effectively means you cannot be making any additional claims before the officer, but then I would request you to still go ahead and make a claim before the assessing officer by way of a submission, by way of a letter or a computation that this is something that I was eligible to but I have missed. And along with your submissions, please rely on circular number 14 of 1955, wherein CBDT has instructed its officers to not to take undue advantage of the ignorance of the assessee. Wherever assessee is eligible for certain rights and privileges, wherever he is eligible for some refund, it is the duty of the assessing officer to guide the assessee. It is the duty of the assessing officer to guide the assessee. So your submission to the assessing officer should be, hey, see, I was ignorant, but now that it has come to your knowledge, you please allow it. I am debarred from making a claim, but you are duty bound to allow me that claim. That's the force of Circular 14 of 1955, again reiterated in some sorts by the recent Taxpayers Charter, which was adopted in 2020. There again, the CBDT has taken this up to say that taxes shall be collected only on the correct quantum of income. That's there in their Taxpayers Charter. Also, but despite of you putting all of this elaborate legal submission, end result we all know in the assessment order it is not going to be allowed. But then this will create a base for you to fight it out in the appeal, where we have this landmark judgment of Bombay High Court in the case of Prithvi Share Brokers Private Limited, wherein Bombay High Court very neatly distinguished Supreme Court in the case of Goethe India to say the bar created by Supreme Court in Goethe India applies only on the assessing authority. It does not apply on the appellate authority. So if the assessing authority has not entertained your additional claim, it is always open for the appellate authority to entertain your additional claims and give necessary relief. But then for all of this to happen, the foundation has to be laid in your assessment proceeding, right? So wherever you see assessee has missed out on any claim that he ought to have made in the return of income, it's not end of story. Still fight for it, claim for it in the assessment proceedings, and you're certain to get it at least in the appellate proceeding. Ask for virtual hearing at the end of every response. This is something our office does. End of every letter. He's not going to give, I know it. But end of every letter, please request for an opportunity of personal hearing to better explain my facts and better explain my submissions. Now what happens is, principles of natural justice we've already seen is a necessary component of assessment proceeding. Any assessment proceeding which is in violation of principles of natural justice is bad in law. So bad in law means court will quash it. Unfortunately, the current mode of the courts is not to quash such assessment proceedings where sufficient opportunity is not being given. The latest trend is to set it aside and remand it back to the assessing officer for a second inning. That is not what we want. But then we hope that sometime or by the time when my case comes up for appellate stage, maybe the mood of the court would have again changed and they will again start quashing the orders rather than setting it aside and remanding it back. So this is something that you can try. End of every submission, make a request for virtual hearing. Faceless regime gives you an option to be aggressive in your submissions to the erstwhile regime. We were a little held back. Face-to-face interaction. You can't be writing submissions like assessing officer has failed to apply his mind. You have to be conscious of what is going to happen in other cases also. No, that's not the single case that you're going to deal with him. So you were a little held back. Now that limitation which was there in a physical environment is no longer there in a faceless environment. You don't know the officer does not know you. Be brutal in your, I'm not saying be, pass any derogatory submissions in your submissions, but then you have all rights and freedom to now be aggressive in your submissions, right? Ask for cross-examination. Now this is a right you have to positively exercise in the course of assessment proceeding only. By the time the case reaches appellate proceeding, it might be too late. A lot of times, show cause notice would be relying on some statement of a third party for making addition in your client's case. In all those cases, it is your right to ask for an opportunity of cross-examining that third party basis whose statement adverse conclusions are being drawn in your case. Ask for copy of all materials. Officer will serve show cause on the basis of information received from GST department, investigation carried on by the investigation wing, information available in my hands, reports available in my hands, it is concluded that you're party to a bogus purchase transaction, XYZ. Case could be anything. In all these cases, again, it's your right which has to be positively be exercised to seek for a copy of that information on the basis of which conclusions are being drawn in your case. You are also entitled to ask for copy of order sheet notings and case records. This becomes relevant and important in cases where there is a lot of behind the scene activity happening. Let's take a simple example of reassessment. No, reassessment involves a lot of procedures and approvals. There are timelines. So there has to be some recording, then it has to go to a higher authority has to give an approval and then notice. So there is a certain sequence and certain procedure and certain timelines to be met, which are otherwise not visible to you. The notice, 148A notice or 148 notice will not give you the entire background of what has happened behind the scenes. So, but you have a right to inspect your case file. You have a right to inspect the order sheet notings, and in fact even a right to take a certified copy of these order sheet notings, and that right is given to you under Circular 17 of 1965. Circular 17 of 1965. In practice, they will not respond. They will not, honor this circular also. A easier option is file an RTI. Costs you 10 rupees. Within 30 days, he has to respond, and they will respond. That's more powerful. That's an entire act sitting on the officer vis-a-vis a circular which he is simply going to brush aside. This is very critical. Demand on account of tedious credit mismatch cannot be enforced. This to me is one of the most blatant illegalities that the department has been carrying out for quite some time, and for some strange reasons we've been quite silent about it. We seem to have surrendered ourselves on this particular aspect. Now, let me try to explain this issue with an example. Let's say there is TDS to the tune of 1,50,000 in my case. Out of the fees that I am entitled to, 1,50,000 has been deducted as tax at source. But on 26 AS, what is appearing is only 1 lakh. Now, if my return, I am claiming a refund of, let's say, 2 lakh rupees, my refund will be restricted only to 1,50,000, which is perfectly alright in terms of section 199 read with rule 37. Credit has to be given only to the extent it is appearing on form 26As. I have absolutely no issues with this up till this point. Let's continue with the example, and let's say I had no refund. I had no refund with the department. I have claimed full 1,50,000 as TDS credit. I have made some payment of self-assessment tax as well. My return says no taxes payable, no refund receivable. It's a zero refund, zero payable scenario. But then CPC would issue a 143(1) restricting your TDS credit to 1 lakh, fine with it, and raising a demand of 50,000. Now that demand of 50,000 raised by CPC is directly barred under clear provisions of the Act. 205 of the Act creates a clear bar on the department from recovering this demand from the deductee. This demand can only and only be recovered from the deductor and never from the deductee. This is a very clear, plain interpretation of 205, reiterated by the CBDT in its instructions of 2015 after that famous Delhi High Court suo motu PIL. Department had to come out with this instruction where department has very clearly instructed. See, what does it read? Where tax has been deducted at source but not deposited by the deductor, no demand shall be enforced coercively against the deductee. The assessee cannot be put into any inconvenience on account of default of deposit of tax into the government on account of the into the government account by the deductor. Now see, who's deductor? Deductor is the agent of the government in this scenario, in this setup. In this setup where a client is making a fee to me, deducting tax at source, and that tax is remitted to the government, that deductor is an agent of the government. And if there is any default at his end, it is the principal who should suffer any losses, not the third party with whom the transaction is happening. Right? So, if at all the demand has to be recovered, it has to be recovered from the deductor. It cannot be coercively enforced on the deductee. Subsequent years refund being set off against such demands is a clear illegality on the part of the department, which it itself acknowledges. The CBDT instruction of 2015 is still live. In fact, the CBDT instruction was again followed with an internal office memorandum of 2016 where they reiterated this: please don't make any adjustments, please don't enforce such kind of a demand. And there is a plethora of High Court judgments also on this, including our Karnataka High Court in the case of Anusuya Alva, wherein Karnataka High Court has again categorically held 2011 is a provision available in the hands of the government. No, if the deductor has, after deducting, has not remitted the tax, please chase him under 2011, recover TDS from him, levy interest at the rate of 1.5%. You cannot be penalizing the deductee in this arrangement where the deductor, who is an agent of the government, who has defaulted. I know I'm coming to the end of my time limit, but then there's one more. I'll not stand for too long between you and your lunch, but then I thought there's one more segment that we should be addressing, raging issue with regards to 143.1 intimations, which I thought merits mention in the today's session. I understand intimation under 143.1 is technically not a assessment. Supreme Court way back in the case of Rajesh Jhaveri stockbroker has concluded that 143.1 intimations are not assessments. But then there's one issue I thought which merits discussion at this forum here. We've all seen, most of us would have seen this demand being raised under 143.1 intimation with regards to other incomes that are being credited to the capital account. So in case of a business SEC, mostly this is something that you will see in case of an individual or HUF. So there is a business P&L and there are certain non-business incomes. There is a rental income, there is a capital gain, there is interest income, which is not credited to the business P&L, but it is credited to the capital account of the SEC. Now, as tax auditor, I have a reporting obligation under clause 16, to be more specific, clause 16, subclause D of Form 3CD, wherein I have to report these incomes as incomes not credited to the P&L account. So this is how your 3CD is going to look like. So there is interest, PPF interest, there is joint account interest, there is rental income, all of these which has not been credited to the P&L account and reported by the tax auditor under Form 16. And the moment under Form 3CD, and the moment you report it in Form 3CD, a corresponding reporting is captured in your ITR. In your ITR, there is one Part A, other information. There is row 5D to be precise, wherein this 7,48,000 of income which is not credited to P&L account but credited to capital account, which is getting captured here, right? So this is how the return gets uploaded. And then what happens? You get a 143.1A intimation. Intimation will look something like this, right? So it will propose to add that 7,48,000 as income from business. Now this 7,48,000 is not at all income from business. It has already been offered to tax under the head capital gain, house property, income from other sources. But CPC को समझ में नहीं आता है. So it will give you a 143.1A intimation. No matter what you respond, how detailed and how much you try to explain, this will next translate into a 143.1 intimation, wherein that 7,48,000 is going to be added as income, on the ground that it is an incorrect claim. I don't understand how it is an incorrect claim. We can get into a legal discussion or a legal argument that it is not a claim in the return of income. It is some additional income that you are trying to tax. I have not claimed it. You can get into that legal argument and maybe file an appeal, or I'll give you an easy way out. File a request for rectification. Make a 154 request on the online portal, and while making the request, select the option which allows you to file updated XML, updated JSON, updated ITR. Now there, what you can do is add that 7,48,000 in the schedule BP row number 23. Now this is what actually they wanted. Now this is what they've asked for. If you read carefully the initial intimation that you get under 143.1A, it reads, in schedule BP serial number 23 should be minimum of sum of amounts entered at serial number 5A to 5D. Right, so this schedule 23 is what you're seeing on your screen. Give them this number over here. Let the system, let the CPC be happy. But then my income is going to increase by 7,48,000. No. How do I address that? You address that by taking a corresponding deduction for the same amount in clause 32, in row 32. Same schedule. So in row number 23, make an addition of 7,48,000. Come down a couple of rows. Row number 32, you'll find a column for any other amount allowable as deduction. You claim that same 7,48,000 as deduction, file a rectification request, CPC में demand will become 0. But this comes with a disclaimer. You've addressed the issue that you're facing under 143.1, but this may result in 143.2. What is that 7,48,000 other deduction that you have claimed may be a point of scrutiny. So subject to that judgment of yours, this is something that you can explore. I think I have exceeded my time. Thank you all for a very patient hearing. Thank you.
Thank you, Deepak. That was an enthralling session and much needed at this point of time when all of us are going through the challenges with the assessments which are due for completion before 31st December. On behalf of Bangalore branch of SIRC, I thank you for taking your time out and coming here and sharing your knowledge with us. Thank you so much. I request Treasurer Manjuna Thallo to give our speaker a token of appreciation and gratitude.